A lot of people that invest in foreign real estate outside the US, and a lot of times that's going to be a rental property. So people want a second home in Costa Rica and they're going to rent it out when they're not there. One of the things we do from a tax perspective with these rental properties is generally when you factor in depreciation, you're going to have expenses you can take in excess of that income. So you have a loss from this rental property. And what we're generally trying to do from a tax perspective is how can we use that loss to offset ordinary income? Because the regular tax rules say that that loss is passive and it gets parked in this passive activity basket and you can only use it later when you sell the property or make money. But there are ways that we can actually take that loss and offset it against ordinary higher taxed income. One of those ways is the real estate professional rules, but the other is the short-term rental property or the short-term rental loophole. So today in this video, we're going to talk about the short-term rental loophole, how it could apply to you, how it applies to expats, and the nuances associated with it and why you might not fit into that squarely like you think you do just reading the rules online. If this is your first time watching, my name's Alex McGowin, owner of McGowin Tax, where we help individuals and small businesses solve international tax problems. So the typical situation I run into, right, is a US individual, they spend a ton of time in Bali or Costa Rica or some great vacation destination and they want a home there. And they figured they can offset the cost of their vacation when they go to these places through Airbnb and these short-term rentals. And that's a great plan. So what we do from a tax perspective is what can we do to utilize those expenses and losses so that they can offset ordinary income. The short-term rental loophole is something that's become a lot more active and a lot more applicable to people because of things like Airbnb and VRBO. So what it technically says is that your average rental period over a year can't be more than 7 days. So that means that if you take the total bookings, if you take your Airbnb listing and you take the total bookings over the year and divide it by the number of days, that has to be less than 7 days or less than or equal to 7 days. And if it is, then it's a short-term rental and you're not blocked on your losses from that rental. You can actually use your expenses, the net loss. If you're liking this video, you should really check out my newsletter where I put out different tips and tricks, latest law changes that can really help you save money and save complexity if you're living or investing abroad. Just think how much you could save with the right tax advice. To offset your wage income, which is a great deal. So how do we get there? The first step is, even if that happens, if you have personal use days and it's considered a mixed use property, you have to split your expenses out. So you can't just take all of your expenses for the year and put that on your Schedule E on your tax return and then the loss offsets your ordinary income. You have to apportion it. So if you spend 50 days in the property and you rent it out for 100, then we can take 50% of your expenses and apply it to that property. And if you meet this 7-day rule, the short-term rental loophole, then we can take that loss and offset it against higher taxed income like wages, which is a great deal. But what people miss is the personal use days can actually kick you out of that rule. And it's a little more stringent than you think if you're spending time there. So the technical rule on the personal days, if you have too many personal days, then the IRS says it's actually not a rental property anymore. It's a personal use property, and you can take deductions up to your rental income. So you're not paying tax on it. But if you have excess deductions over your income, so a loss, you can't use that loss. So then we're back in the same place we were in the first place before the short-term rental loophole. So what the rule technically says is it's going to be considered a personal use property if your personal use days are the greater of 14 days or 10% of your fair rental days. So the way that works in practice is, let's say you had 100 rental days during the year and you spent 20 personal days in that property. And let's say that this 100 rental days, we met the 7-day test, right? So we meet the rules for the short-term rental. We have a net loss. We're offsetting it against our W-2 income. Everybody's happy. We're saving money. Then we look at your personal use days. So we say this 10% rule. Remember, the rule is your personal use days can't be more than the greater of 14 days or 10% of your rental days. 10% of your rental days here is 10, and you had 20 personal days. So you're actually more than both of those in that scenario. So your days are going to exceed exceed that threshold. So now it's a personal use property, and this short-term rental rule doesn't apply, unfortunately. You're going to be stuck with not being able to use those losses. Now, the good news is if next year you spend less amount of days, you can lump the losses together so that it unlocks all the losses at the same time for you to utilize in that year. So for example, let's say you meet this short-term rental test, say for 3 years in a row, but you spend a lot of personal days in that property in each of those years. So let's say your loss was $5,000 each year, and that got limited because of your personal use days. Now you're sitting on $15,000 of losses. Well, let's say in that 4th year, we want to use those losses. So in that case, we need to hit the 7-day rule so that the short-term rental rule is met. And then we need to make sure we don't cross the barrier for this personal use days rule. And in that case, we'll be able to unlock all 15,000 of losses and that year's losses to offset your W-2 income in that year, which is a pretty good deal. So even if the personal use days is a problem, like for 1 year, you can plan it ahead of time to where there's 1 year you just end up spending less days in that property. Maybe you even go rent out a property right next door to your property in some cases, because in that case, yeah, you're gonna have to pay the rental, but you're gonna unlock 15 grand of losses potentially. And think about it, particularly in that first year where you're gonna have a ton of expenses, maybe improving the property and things like that. That loss, unlocking it later in a year maybe where you have more W-2 income could give you a really big bang for your buck. So if you're navigating these short-term rental property rules, it's not as simple as just making sure that your rental days are less than 7. That's a part of it, but we have to be careful around these personal use days. It's not hard to strategize around it to where we can use these losses. It just takes advanced planning and actually thinking it through and being intentional about the way you utilize these rental properties. If this is something useful for you, or if you have questions about how these rental properties can work, because it can definitely get very confusing, reach out to us at McGowanTax.com. I'd love to talk to you personally about your situation and how we may be able to help you. Leave a comment here. If you're renting a house out in Costa Rica, let me know. Give me a thumbs up. Love to hear how you're planning about it, or if you have questions, we'd love to hear. Thanks for watching.